All right, everybody, we are back talking with Robert Horrocks, the Chief Investment Officer of the $2.2 billion BMO Guardian Asian Growth and Income Fund. Do we have that right?
Well, the BMO Guardian is actually a fund we sub-advise. It's Matthew's Asia Funds is the series.
All right, I want to make sure we do have it right because we were just talking about it. Let's go back to what you're seeing in terms of Asia. So no doubt about it, this is where we're going to see, not Asia, but China specifically, tremendous, tremendous growth. How do you're obviously investing for the long term. I mean, what are the strategies you're putting in place? Is it kind of everything?
No, well, I mean, the big growth is happening in Asia, and I would emphasize that everybody looks at the headline rate of growth, which is expected to exceed that in the developed world. We would agree with that, but there's also a structural change underway that there's going to be a greater emphasis on consumer growth, on domestic demand. And if there's one theme that holds our investment philosophy together, it is that if you invest in companies that facilitate the growth in wealth and sophistication of the Asian household, participate in the growth in spending of the Asian household, then you've got one key growth trend going for you.
To me, that also means, though, companies like Walmart, who are expanding tremendously in China, Disney looking to, kind of get their foothold in China. I mean, it's a lot of different players here.
You can certainly get exposure through some multinational companies.
Right.
But what you want to do is you want to get hold of companies that really have an affiliation with the domestic consumer, that have really become part of their psyche and part of their everyday life. For the most part, you'll see that in domestically grown companies rather than the multinationals that come in, although they do have a good brand image. But the thing about China is that you used to invest in the companies that were making stuff for Walmart. Now they've turned their business models around. They're building their own brands. They're no longer the contract manufacturers, but they're building their own consciousness and brand image amongst the people. That's a very different investment experience in China in the future than you would have had over the last 10 years.
Let me ask you, because I think so many people are setting up thinking you can play those U.S. multinationals, that's the way to play China. But from what you're saying, not necessarily, certainly not longer term.
It's a way to get exposure to China. But is it the most concentrated and effective way to play China? Well, maybe not. I would flip it around as well and say that those people who also naively allocate to Asia, they may be getting a lot of the old export industries in the benchmark, and all they're getting is exposure to the U.S. and European consumer through an Asian company, rather than exposure to the Asian domestic demand growth, which is what we focus on.
You take also an incredibly long view here, right? I mean, a decade, maybe more. Do you try and find a way to protect yourself against the bursting of bubbles? Because emerging markets are obviously notorious for that, and China a dangerous place to invest for the same reason. I mean, you have to expect bubbles to blow up and pop a few times over the decade.
Sure, you have to, when you're investing in these markets, you have to accept that risk profile. So we say strategy matters. And that's why when we first started investing 15 years ago, we launched two different strategies, sort of both an expression of the same long-term view, but one offered a more aggressive growth profile to invest in, and another tried to participate in the growth of Asia by focusing on companies that pay a dividend, and also by including securities like convertible bonds in the structure. So the other key thing when you're thinking about investing in Asia and in China is that it still matters the strategy you choose. You still can choose a fund that gives the right risk-return profile for you.
Quickly, I want to ask about the yuan, since the president's headed over there. Obviously, the U.S. would like to see China allow the yuan to appreciate, but you don't think it's going to happen?
I doubt very much it'll happen quickly. China has no interest in allowing a very rapid, big appreciation in the yuan. They're trying to allow their entrepreneurs time to change the business models to focus more on the growing domestic demand. And they don't want to shoulder the whole burden of a correction in the global economy on their own shoulders. Now, at the same time, they've been making hints about the US dollar maybe losing its status as the international currency, and I think they're probably trying to use a little bit of leverage here. I wouldn't be surprised if, after the meeting with the president, if they maybe did a token small appreciation. That might be on the cards, but I don't think you're going to see a big one-step jump.
All right. Hey, Robert, thanks so much for joining us. Robert Horrocks there, CIO of Matthew's Asia.